The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Please consult your tax advisor, even if it's us, to find out how this may apply to your specific situation.
Hey listeners, and welcome to Tax Trails. Today, we're really excited to bring you an episode where we're going to talk a little bit about the tax plans of both presidential candidates. With the election coming up in just under a month, we'd like to give some more detail on the plans that both are proposing, so you can have a more educated opinion of their tax plans when you go to vote. Here are your hosts, Derek and Spencer.
Thanks, Chandler.
Thank you so much.
Real quick, we'll jump in with some important dates. Relevant to this topic in particular are the election is actually coming up on Tuesday, November 5th. So we're just a couple weeks away. And then relevant to the overall concept here is that the current federal funding is set to expire on December 20th. And then Congress convenes on January 3rd, 2025. And so those are all going to be important dates that apply as tax laws are being discussed and planned upon, right?
Yeah, so pretty much everything we're talking about today is like what's been proposed.
Right.
Obviously nothing hasn't been set in stone yet. Those dates are important to know because that's when most likely tax policy will be actually talked about, enacted, and so on.
Exactly.
So, yeah, thank you, Derek, for those dates. We kind of wanted to just answer the question of where have we been. We haven't posted in a little bit. And part of the reason why is because of the extension deadline. That kind of, at least for me, it pretty much rocked my world. I worked a lot more overtime than I thought I was going to. So we haven't given up on the podcast. Obviously, we're here now, and we have some plans to come out with more episodes later in the year.
Yeah, we've just been busy.
Yeah. Again, we're working professionals. We're doing this kind of as a side thing for you specifically listening. We're trying to help you with the topics that we're talking about. So awesome. And speaking of topics, let's just hop into it.
Yeah. So right off the bat, both candidates have a few tax proposals that'll affect individuals. And first one is something that it's actually been bandied about by both parties at one point or another and different representatives from each party. But Harris is proposing to expand the child tax credit up to $6,000 for children under the age of 1 and $3,600 for children aged 2 through 5, and then $3,000 for older children. And these type of credits and policies are generally met favorably by everybody in the country.
Yeah, most people, I would say, would like that. Me included. I have two kids.
And so there's a lot of widespread support for something like that. And then interestingly, both candidates have proposed to make tip income tax exempt, which is really interesting. And, whether or not that's a good policy, it seems like there's a lot of support on both sides of the aisle for that to happen, right?
Yeah, I don't know where. I know one of the candidates was in, I believe they were when they proposed this for their candidacy, they were in Las Vegas, and then Las Vegas is one of the biggest tipping areas in the U.S.
Got it.
And so coming from, this is my opinion, they wanted to do that there to help gain the voting in that area, right?
Yep.
And whether or not, and at the very end we'll kind of talk about likelihoods of things, and I'll just say this now, but whether or not that actually happens, who knows? But it is an interesting concept. I've been reading about it, listening about it from other professionals in the industry, and it's. I mean, I don't want to give too much personal like biases on whether I like it or not, but let's just say it's just going to make make it more difficult for us for sure.
Yeah. Yeah. In general, you'll see our opinion has much less to do with political leanings and more to do with how much harder is this going to make my job? So,
Yeah, we will express an opinion on that kind of thing.
Yeah.
exactly.
Yeah. Well, whether, I mean, obviously, like, it's a fact that if you exempt tipping income, it's going to lower the revenue to the federal government, right? Like, there's two ways that the government makes money or gets money, and it's through bonds and it's through taxes. And so if you take away this portion, they're just
Yeah, you're cutting off one of the streams.
of income for
Yep.
the government. So just keep that in mind. Moving on to talking about individual income taxes, kind of like as a whole. Currently, we are under the TCJA, and I like to refer to it as TICJA. It's just a
Yep.
lot easier for me to say.
Chandler and I always call it TCJA. So,
Yeah. So if you hear TICJA, it's TCJA. TCJA is just the Tax Cuts and Jobs Act that Trump enacted right after he was put into office.
yep.
And one of the things that he changed was the tax rates and the standard deduction. And that would be expiring in 2026. So 2025 would be the last year that these TCJA, TICJA rules would apply. And in 2026, it would be reverted to pre-TICJA tax rates and standard deduction amounts and also itemized deduction rules. Harris's plan is to just let it be repealed, and in the top marginal tax rate would go to 39.6%. Trump's idea would just be making the TICJA tax cuts permanent. However, I guess I'm jumping the gun, but with the SALT thing, he's going to be doing something a little bit differently, but you're talking about that. So
Yeah.
Trump would make the TICJA tax cuts permanent. So pre-TICJA tax rates was 10%, 15%, 25%, 28%, 33%, 35%, and 39.6%. And now during TICJA, it's 10%, 12%, 22%, 24%, 32%, 35%, and 37%. So just a flat decrease on all tax rates across the board. It would be reverted to going back to those pre-TICJA.
And I think for me personally, and as a working professional, one of the larger things that I want to stay, which I hope happens, is the increased standard deduction rates, right? So, not that we spend all of our time doing individual income tax returns, but it really just simplifies the filings for a lot of people with increased standard deduction.
Yeah.
Right. We don't need to track down every additional receipt and statement if you're just going to be taking the standard deduction. So it can make our lives easier.
Mm-hmm.
Well, I think I know at least for Spencer and I, TCJA has been intact since we started preparing taxes. So selfishly, I'd like to
Keep it the way it was.
keep it the way it is, so I don't have to learn too many new things all at once.
Yeah. All right. So moving on, another individual income tax item. Harris. So right now, there's a net investment income tax that can apply on certain types of investment income that an individual may have, and it's an additional 3.8% tax on that income if you fall into certain categories. Harris is proposing to increase that net investment income tax up to 5% for individuals making more than $400,000. So there would be some sort of phase-in between, so individuals who are making $200,000 would be the 3.8%, and then over $400,000, they'd be paying the 5% on that income.
Yeah. And Trump, we don't know if he would increase
Yeah,
that.
there's been no statement on that from Trump. So unknown. It likely, probably nothing would be my guess, but who knows?
Yeah. And I don't know. For some, it might not affect anything because, again, it's like Harris would not be increasing it for anyone under that $400,000 threshold. But for others, it could be a significant increase, especially if you have a law of net investment income tax. Net investment income tax comes from interest, dividends, capital gains, like that sort of thing.
Yep, and your passive investments in
Businesses
and whatnot. So, really, it's the more wealthy people that are subject to more of this, right? Because typically the people who are able to get passive income, they have more money that they can just put somewhere and let it grow. When you have less money, you've got to be more actively involved in whatever your money is doing. Anyway.
Yeah. Perfect. Yeah. So beyond that, we're talking kind of within net investment income tax. We also kind of briefly talked about long-term capital gains, and this has been a pretty big buzzword with especially the Harris campaign of taxing, unrealized gains. Currently, there's the long-term capital gains is taxed at 20% if your income is above a certain threshold.
Yeah, long-term capital gains goes all the way from potentially 0% tax, right, to 15, and then to 20. Yeah, so
15% if you're in the lower income, and then 20% if you're in that higher income. I guess 15% would be in the medium, I would say.
Yeah, because it's 0 up to what, $90,000 or so of income, somewhere around. It's just under $90,000, I think. Anyway.
Yeah, but she would be Harris would be changing that if you have income greater than $1 million. It would then go up from that 20% to 28%.
And 28%, isn't that the other capital gain rate right now for collectibles and items like that?
Yeah, there's some other.
Isn't that where that's at as well?
Yeah, it could be.
Anyway.
If they're following, I could be following that same methodology.
Yeah, I think that's probably kind of the idea of where that number comes from.
Yeah, a lot of the Harris tax changes are mainly geared towards wealthier individuals. You'll see that like $400,000. If you have and I'm assuming it's AGI. If your AGI is over $400,000, you then have to start applying these sorts of tax rates. Kind of also with the next point that we're going to be talking, and also Trump he hasn't talked about changing or keeping it the same, and so I'm assuming, I have no idea, but I'm assuming he wouldn't change it at all. He'd just keep it the way that it is.
Yeah, it's interesting. It seems like in some of these places, there's got to be some changes, right? As you cut somewhere, there's got to be you got to bring something back somewhere else. So where that's going to be, how that's going to work, I don't know. Anyway, we might touch on some of that. The next item is minimum tax for high net worth individuals. So this is interesting, but right now there is no such thing as a true minimum tax on anybody. Like there's no minimum.
At least not at the federal level.
At the federal level, yeah, and there's alternative minimum tax. That's a different thing, but that doesn't exist. Harris is proposing a 25% minimum tax on income, and this is including the unrealized capital gains if net worth is greater than $100 million. And so this has been much maligned.
Yeah, you can find people on both sides of the aisle for this one for sure.
Yeah, and for lots of reasons, right? Like there's so many issues with taxing unrealized gains, and they've been talked about all over. But like so every year you're going to have to get a valuation on everything in everybody's life, and to come up with these numbers, and then they're going to be taxed, and a lot of these are illiquid assets, right? And so in order to pay the tax on them, you're going to have to
liquidate some funds.
Liquidate funds or find a way to sell them. But the act of selling things can change the value of things.
It'll change your net worth.
It'll change your net worth.
Possibly.
Exactly. So there's all sorts of issues associated with this.
I would just say whether you're for it or against it, there's just more added work that we'll have to do. More tracking. So
Yep, 100%.
Just make things more complicated.
It seems unlikely, an unlikely piece of the tax proposal to to make it through.
Yeah.
But
Yeah, we were listening to a training this morning that was going over these different items that we're talking about today, and I remember one of them said specifically that it was, quote, dead on arrival. It was DOA.
yeah,
This specific piece. So, is it just a talking point to gain votes, and it's never going to
and it sounds nice.
fruition?
It sounds nice. Nobody, an average person, we can't relate with somebody who has a net worth over $100 million.
Right. I mean, we're talking about 1%ers here that they're even directing this.
And so, and so, in theory, that excites voters. We're like, yeah, tax the rich people. They can pay for our government, right? And it's a ploy. Anyway, and obviously Trump does not have a similar proposal.
Correct.
So
And maybe for those unaware, we should just kind of do a quick explanation of what an unrealized gain is.
Yeah. So
Sure.
essentially, I feel like most people have money in the stock market, whether that's through retirement or just kind of your own personal funds that you're doing on your own. And unrealized capital gains would be, let's say you bought stock a couple years ago for $5, and today the fair market value of that stock is $10. Well, now you have unrealized capital gain of $5. And so it's just the difference between the fair market value at the time of whatever you're looking at to whatever your, like, what we would say like your cost basis or however much you paid for to get it.
yeah,
So it's still in your account. You haven't sold it yet.
you haven't actually made any money yet.
Exactly, yeah. You
You
haven't made any.
realized the gain.
Yeah.
Yeah.
That's what we say.
Yeah. So that's why it's called unrealized capital gains. So you haven't made any money. You haven't sold it. It's just a value on the screen.
And that can apply to any sort of holding you have. It could be your family business,
Yeah.
right?
Yeah.
It could be
Your house,
your house. It could be
your paintings, if you have really.
sure. Yeah, exactly. Exactly. That applies to anything in unrealized gain you could have on anything. And so anyway, it can quickly become a really burdensome problem.
And part of the reason, I mean, historically, these have not been taxable is because they can fluctuate so much. I mean, go back to Spencer's example of the stock market. It could be worth $10 today, and then tomorrow the value of that stock could drop to $1, and so you've switched to an unrealized loss. And so I think that's part of the reason there's not a lot of support and a lot of maligning is, it could be an unrealized gain at 12/31 at the end of the tax year, and then a couple months later, now it's suddenly a totally different scenario and worth a totally different value, and now it's a loss. And
Yeah, it would make tax planning a lot harder.
Yep. One of the things, too, I think they're trying to attack or work on with this is, so there is a step up in basis that can happen, right, when somebody passes away. And so I could have $5 million of unrealized gains in the stock market, and I'm going to pass away and pass that on to my estate,
Yeah.
right? And the people that get that, they're going to all of a sudden get a step up in basis, and so now that gain is just gone forever.
Yeah.
Right.
Yeah.
And they're kind of trying to work on that and saying, hey, these wealthy families are avoiding these
Potential gain
potential gains and avoiding these taxes by holding it forever.
by
And
dying.
yeah. That's like, okay, that's a fair price to pay for dying. Anyway, I think that's one of the things they're trying to get at there. But
There's different avenues.
There are, and so yeah.
Yeah. Pros and cons. Next thing that we've kind of talked about it in previous podcasts where we're talking about QBI or qualified business income deduction or section 199A, or some people will call it 199 cap A. And that's essentially, in the simplest way that we can explain it, is just a 20% deduction on qualified business income. And that qualified business income is normally through like pass-through entities. That is going to be, that's part of TICJA, and that'll be going away in 2026. So 2025 will be the last year that we have this QBIA deduction. And Harris has not talked about if she wants to keep that going, but Trump has talked about making it permanent as part of TICJA, right? And it came about pre-TICJA, it wasn't even a thing. And then when TICJA happened, Trump lowered the corporate tax rate to 21%, and then he also did this QBIA. So not to get too into the weeds, but when he lowered the corporate tax rate to 21%, it was at, I think, 28% or somewhere around there. And it really incentivized people, oh, well, maybe I should make a C Corp now instead. Because
I should turn my partnership or my S Corp into a C Corp because look at that preferential tax rate.
Yeah, exactly. And so in order to combat that, he made this, or they proposed, him and the team that was working on it proposed and did this QBIA to where, well, you can make a C Corp, but now you're going to be not going to be able to have this QBIA where it's 20% of your business income is a deduction against your AGI. So Trump would like to make that permanent. When it was proposed, it was always going to sunset, so it's sunsetting and expiring after 2025. So,
yep. And the last thing that's really individual focused is the state and local tax deduction cap, or the SALT cap. So pre-TCJA, on your federal income tax return as an itemized deduction, you could deduct taxes paid to states and local taxes. Right, that's an itemized deduction. You live in California or somewhere on the coast where they have a high individual income tax rate for an individual, and you pay your $50,000 in taxes to that state. You got to write that off and deduct it on your federal income tax return. Great, that's a little benefit. They're basically trying to say, hey, we don't want to double tax your income. Essentially, is what's happening there. They're giving you a little break, and TCJA comes along, and okay, they brought on all these cuts. One of the things they did to offset all these tax cuts was, hey, we're going to limit this state and local tax deduction. All right, $10,000. Okay, great. A couple years go by.
and
People are smart, right? People are like, man, I'm really bothered by this. I do not want to pay these taxes. So what comes around? Well, these pass-through entity tax deductions, right, Spencer?
Yeah. And we might have talked about it a little bit before.
I'm sure we have. And basically what that is, so you have this income, you've got your small business or whatever, a partnership or an S Corp, and you can now make an election at these levels to say, hey, the entity is going to pay tax. My theoretical state income tax that would have flowed through to me individually, then I would pay. The pass-through entity is going to pay this tax on my behalf, and I'll take the deduction at the entity level, and therefore I get my deduction back.
Yeah, it's a workaround.
It's a workaround, and it complicates tax filings, and you have to know what states allow it, what states don't. When can it be considered fulfilling the composite, factor of, well, do I need to still go file a separate income tax return in that state now or what? And basically, it's made our jobs a little bit more difficult.
Yeah.
Right? So this is an area where like, yeah, let's get rid of that SALT cap. We're happy to let that one expire. And it's kind of fun. Spencer mentioned that training anyway that we were listening to earlier, and part of it was titled 2025, the Tax Super Bowl. And the reason that's the case, I mean, there's one way or another, there's going to be a lot of tax laws that come up in 2025 due to the sunsetting of TCJA. And it also happens to coincide with a presidential change. And so,
Right.
100%, this is going to be the tax Super Bowl in 2025. And,
We'll see what happens.
We'll see what happens. So that's kind of our individual stuff.
Yeah, and just to kind of go back, Harris hasn't talked about that at all.
That's
What
true.
we know,
She is a California person, and
she might be
and
favorable.
so maybe she's going to be favorable to that, because that's typically where most of the pushback has come from, is the
states with higher.
the states. Yeah, so California, New York, New Jersey. Those are kind of the states. The people that live in those states feel like they are getting burdened with that more so than others, right?
Yeah.
And so
Well,
anyway,
and even in Utah, we're doing these elections for people in Utah.
yeah, and we just have a
It's like 5. It's like
4.5%,
4.65.
4.65 tax rate.
and we're doing we're calculating it on our end, and so I can't even.
Yeah, we do it for anyway.
But Trump would eliminate. So even though he wants to make the TICJA Tax Cuts Jobs Act permanent, that's one of the things that he would not make permanent, and he would eliminate that.
Where's the money going to come from? I'm getting nervous.
Yeah.
Anyway,
Okay, so going on to businesses, the business section essentially. So we'll talk about U.S. Let's just talk about U.S. corporations as a whole first, and then we can kind of talk about more of the flow-through entity stuff. So for U.S. corporations, the corporate statutory income tax rate currently is 21%. So we kind of talked about it earlier. TICJA reduced the C Corp tax rate to 21%. Harris wants to bring it back up to 28%, and Trump wants to even lower it further to 20%, and a caveat, 15% tax rate for corporations that only manufacture products in the United States. That is a huge tax cut for manufacturing companies if they were to manufacture products in the United States. And we kind of talked about this a little in other podcasts, where one of the ways that the government can incentivize people to do things is through tax law. And you can see that here. Obviously, they want to incentivize manufacturers to produce in the United States, and one way that they would do that is to lower that tax rate to 15%. And then also the corporate alternative minimum tax. So that it's a little bit new. The Inflation Reduction Act of 2022 created this corporate alternative minimum tax, which imposes a 15% minimum tax on the adjusted financial statement income of large corporations for taxable years beginning after December 31st, 2022. So 2023 was the first year. And essentially, even if you had, let's say if you had a really low amount or a loss on your C Corp, they would still look at your adjusted financial statement income and have this minimum tax. Now, it only generally applies to large corporations with an average annual financial statement income exceeding $1 billion. So there's a lot less C Corps out there that this is going to apply. But Harris wants to increase it from 15% to 21%, and Trump hasn't really made a statement on this. So that's pretty much the gist of the C Corp changes.
yeah. I was going to say one of the interesting things, or kind of the offset to the Trump making that 15% tax rate for U.S. manufactured goods, is he's proposed some increased base tariffs on goods being imported into the country. That's kind of where he's banking on making up some ground, I think, there. So that's kind of his offset. It's like, okay, you can manufacture here, and on top of that, we're going to increase taxes on goods being imported into the country. So that's a piece there. Back to our kind of flow-through items. So Trump is proposing, again, he wants to make permanent the TCJA items. So that would mean bringing back 100% bonus depreciation.
Woohoo!
Which we're all in favor of here. It means we don't have to deal with Section 179 deductions, which it's fine, but it just adds another little layer of complexity to our tax returns, right? And so we definitely like that. And then I think what it would do too is bring back allowing us to fully expense our Section 174 items, which we've all been figuring out how to deal with, capitalizing Section 174 and advertising over 5 years or 15 years if they're foreign, right?
Yeah.
And so it would kind of change that around.
Yeah, those two items I think are definitely a lot more favored on both sides.
Yeah.
And I think, just me personally, even if Harris is put in, I don't think Harris has talked anything about the 174 bonus depreciation, but I wouldn't put it past if she were to win the election, those being brought up as well. So, and then, so with that's on Trump's side of things. On Harris's side, she's talked about increasing the $5,000 deduction for startup costs to $50,000.
Oh, is that the $50,000 tax credit for starting a business?
Yeah,
Is that what I get if I start a business? I get a $50,000 tax credit?
according to a lot of people on Reddit or a lot of people on Twitter or X or LinkedIn, even I've even seen people on LinkedIn posting about it, like where they post. A lot of people on LinkedIn will post they'll just take a snapshot of their Twitter post and post it on LinkedIn. And
Oh,
they're
nice.
just like double counting, double dipping, or whatever. But I saw one person. I was gonna bring it up, but I or look at or pull it up, but I didn't. But I just remember it talking about a $50,000 credit to people starting businesses. I was like, that is the worst. Like, that's so misleading to people thinking that they're going to get a $50,000 credit for starting
Yeah.
a business. If you actually know what credit means, I guess if you don't know what credit means, then
Maybe I think that's probably where that's coming from, right? People don't understand the difference between credit and deduction.
yeah.
And we did an episode on that, so we should just refer them to
Yeah.
our episode on credits versus deduction.
That's right. Go listen to that. Basically, real quick, a deduction lowers your taxable income, which is then taxed, and you have a tax number, right? So you have income of $50,000, deductions of $25,000, and then you're going to pay tax on that $25,000 of whatever, $10,000. And if you had a credit of $10,000, that would wipe out all that tax. $10,000 credit, $10,000 tax, gone. Right? That's kind of the difference. You can kind of think of credit as money in your pocket.
Yeah.
And a deduction only reduces your taxable income.
Yeah.
So
Yeah. A credit reduces your tax liability, I would say, and a deduction reduces your taxable income.
yep.
So currently, this is specifically talking about like startup expenses for starting a business. And currently right now you can deduct up to $5,000, and then you have to, anything over that has to be amortized over a certain period up to $50,000. And then you are able to, and then it's reduced. It's I don't know if I'm explaining it very simply, but essentially you can only deduct up to $5,000, and anything past that you have to amortize.
Yeah. And startup costs include basically anything that you have to spend to start your business and before your business actually begins operating is what a startup cost is. So that can be advertising, training, legal fees, research, rent payments, office supplies, and all this stuff that you do to get ready to go before your business actually starts operating are startup costs. And so that can be really large, these amounts. And so this is a big deal. This is an interesting thing that we have to deal with. So the $50,000 credit,
It's not a credit.
it's not a credit, but upping that to $50,000, that is helpful. That is a good change for incentivizing small business, but you still got to spend that money.
Yeah.
Yeah.
Like I hate the way it's been phrased because it kind
Yes.
of makes it seem like, hey, you get this for starting a business, and it's like, no, you have to incur $50,000 of actual expenses and then you can go and deduct them.
Exactly.
I think that what people are taking away from some of these headlines is just, I'll start a business and I'll have a $50,000 tax credit in the next year. And
Yep. Or they're going to give me $50,000 to go and start a business, and we'll see what happens.
I can't wait to have that conversation.
It's gonna
with
be-
someone when.
So I heard I can get $50,000 from the government if I start a business. Should I just start all these businesses and then close them down next year? And I'll make $100,000 or $150,000.
Yeah.
No, that's not how it works.
Your CPA doesn't want you to know this hack.
Yeah,
So
yeah.
Start some businesses.
Oh, my
Yep.
goodness. Yeah.
So beware. It is actually it's a fine change. I understand there is some incentive there.
Yeah,
Just be aware of what it is.
Yeah, it's not as glamorous as probably what you're reading on Twitter or something. So yeah, so those are pretty much all of the issues. Those are the hot topic issues that we kind of wanted to bring up today.
Yeah.
There's also a slew of others that were more niched or nuanced that we thought, maybe the general public, it's not really going to affect them. But I think we kind of talked about the big ticket items here.
Yeah. So one other thing we wanted to briefly mention is the likelihood of things changing, right? So whether it's Harris or Trump, that's only a portion of the equation of any tax law being actually changed, right? Because there are three houses. There's the president, there's the House, and there's the Senate, and all three of them have to come together in some way, shape, or form to enact tax law. And so in this training, we got they gave us some likelihoods of different scenarios happening. Whether it's Trump or Harris, and then whether or not the House or Senate ends up being majority Republican or Democrat. Okay, and so basically the two most likely outcomes are essentially a divided government. Okay, either Trump is president with a Democratic House and a Republican Senate, or Harris is president with a Democratic House and a Republican Senate. Okay, those are the two most likely outcomes
According to this.
according to this poll. We don't really know, and who knows, but those are theoretically, and what that means is it's unlikely that anybody's tax proposals just get through carte blanche.
Yeah.
Right. We're not going to get a sweeping TCJA solidified, and we're not going to get whatever Harris's proposals just solidified. There's going to have to be more give and take.
Concessions will have to be made on one side or the other.
Yeah. Yeah, and I would say that just because one party brings it up and the other party doesn't mean that the other party doesn't also want to do something similar or something like that.
Yeah.
Kind of like we talked about, like the 174 deduction, bringing that back, and also bonus depreciation. That was, those two actually were in a bill that passed the House, and it got, I don't even remember, over 300 votes for yay. It was a very bipartisan, I think is the right term, bill, where both sides wanted it. And that was our first podcast episode actually, was about things with that. So just because Trump talks about one thing and Harris doesn't mean that Harris also doesn't want to do something similar or won't,
Yeah.
And so
The one other point I'll bring up too, with it being divided, a divided government, is it makes it more likely that we get short-term extensions or changes to items rather than permanent or really long-term changes to any of these tax laws, right? They might do, okay, we'll extend the QBID for a year or something like that, right? They might piecemeal this thing, and so that's something we kind of have to look forward to, I think.
yeah, well, a lot of the TICJA, why it's expiring is because of that. So
Exactly.
they were like, in the beginning, we want to give these tax breaks in the beginning, but we'll make up for it after they're gone.
Right.
Because they look at it like what's the outlook of it? Like, what's it going to be like in 10 years? Like, over the next 10 years, what's the net effect, essentially? Is it a deficit or is it a surplus? And so they're like, oh, we're only going to allow these for the next couple of years, and then after that, we'll be able to claw some of that,
Right.
get more income, or claw those deductions back a little bit.
Yep.
And then the 5 years is up, and they're halfway through, and everything's starting to expire, and they're like, well, wait, we want those to stay permanent.
Yep.
And so who knows?
Yep. So, anyway, thank you for listening.
Hopefully this was insightful or informational, and I don't know if this really is going to sway one person or another to vote one way or the other, and but just know, and I don't know, I think
this is an important thing to think about as you vote. If you're just a small, dog grooming person, just you got your little business, you want to pay attention to how these are going to affect you. If you want to start up a dog grooming business, maybe, all right, I can deduct $50,000 of buying my stuff, or I can still get that QBID. Those are things to pay attention to, but
Or if this really takes off, I'm going to have to pay tax on the unrealized gain of my business.
that's right. So there's,
just let it be a piece of your decision making.
let it be a piece of your decision, but also know it's still super nebulous. There's not a lot of info on this, surprisingly. They don't talk about this a lot. They talk about other things that are more hot button, issues. So anyway, thank you for listening.
Thank you so much, and we'll see you guys.
See you on the trail.
For more information about Larson & Company and other educational material, you can find us at our website, larsco.com, also linked in the show description. For questions or suggestions on future episodes, you can contact us at larsonpod@larsco.com. If you would like to learn more about today's episode topic, additional resources can be found in the episode description.